Welcome back to your favorite show, and if it is not your favorite yet, hit that like and subscribe right now. Today we are answering one simple question. Should you add gold to your portfolio, or is a 100% stock portfolio totally fine? And like always, we are skipping the emotional drama and looking at pure quantitative data. आप लोग बोलोगे भाई gold investing में नया क्या है? And here is what most people get wrong. Gold is not a get rich quick FOMO asset. It is a strategic portfolio stabilizer. And today I will show you why keeping around 8 to 10% in gold is the mathematical sweet spot for your wealth. Gold recently hit new highs and saw a standard 8 to 10% healthy pullback. And that makes right now the ideal time to talk about asset allocation. If your portfolio is 100% equities based, then there are three macroeconomic shockwaves that you need to be prepared for. And shockwave number one is the AI Capex reality check. Over the last 2 years, tech giants have spent hundreds of billions of dollars on AI, driving PE multiples to 30x. But revenue monetization is lagging behind. When multiples compress back towards historical averages, as fundamentals always do, tech equities will take a heavy hit. Now, here is a common misconception. Gold does not move in a perfect direct opposite to stocks. So, thinking that if the stocks go down, the gold will go up is a little bit wrong. Historically, its correlation to equities is almost near zero. But that near zero correlation is a superpower. When stock multiples compress, smart money don't hold cash, it rotates into non-correlated hard assets like gold. Shockwave number two is a story that is unfolding for last 6 months. A Middle East oil supply shock. Imagine crude jumping to $120 a barrel. India imports nearly 90% of its oil, and our current account deficit will explode. The inflation will spike, and the central banks will be forced to hold high interest rates, now hitting both stocks and traditional bonds. In a 70-30 equity bond portfolio, both equity and debt take a hit at the same time. But an 8 to 10% allocation to domestic gold acts as a cushion, reducing overall portfolio drawdown by up to 25%. Now, this is an assumption based on mathematics. Shockwave number three is the US debt dilemma and rising yields. US national debt has surged past $35 trillion and is rapidly closing on to $40 trillion. Now, why does America's debt matter to our portfolio in India? Here is a financial chain reaction. To fund this debt, the US Treasury has to issue massive flood of new bonds. But to convince investors to buy trillions of dollars in paper debt, they have to pay higher interest rates. That pushes long-term US Treasury yields. We saw that in last few days when it went up to 5.3. Today, the US annual interest payments alone have crossed $1 trillion, consuming nearly 18% of US tax revenue. The US government is now spending more on interest than on its entire national defense budget. The Federal Reserve is caught in a trap. Keep interest rates high and the government's debt servicing costs spiral out of control. Cut rates too fast and the inflation surges back. When US yields stay elevated, foreign capital gets sucked out of emerging markets like India and flows back to US treasuries. And this is how we complete the connection between US economy and Indian economy, which puts pressure on the rupee and creates volatility in our domestic stock market. And this is why the global central banks, including our own RBI, has been stocking up to hundreds of tons of physical gold in their vaults based on official monthly balance sheets. So they are reducing their dependence on paper fiat debt and backing their own reserves with hard, unencumbered assets that carry zero default risk. So when central banks around the world are de-risking their balance sheets with real gold, you sitting on an unhedged 100% paper equity portfolio is not confidence. It's unnecessary exposure to risk. But obviously, to make sure that we are not giving you bad advice, we ran these asset mixes through Markowitz Mean-Variance Optimization over 20 years of Indian market data. And this is how it turned out. A 100% equity portfolio strong long-term returns but deep 25 to 30% historical drawdowns. In a portfolio with 8 to 10% gold allocation, the portfolio volatility was cut while preserving maximum equity compounding. If you don't know who Markowitz is, then click on the link and read below. But here is one critical warning that matters in India: the taxes. If you buy gold ETFs or funds, long-term capital gains are taxed at 12.5%. If you hold sovereign gold bonds from primary issuance until their full 8-year maturity, your capital gains remain tax-free. But annual interest is taxed at your slab rate. Knowing which vehicle to buy at what protects your net returns. So make sure that you do your own research before you start accumulating gold for your portfolio. So concluding this debate, we started with a question: should you add gold to your portfolio? And the mathematical verdict is a yes. 8 to 10% of your portfolio in gold will help you manage structural market risks for next 9 to 10 years. So I hope this video was helpful and you enjoyed it. Best of luck for your portfolio profitability. If you enjoyed this video, you must like, subscribe and probably hype it. But most important all, किसी दोस्त के साथ शेयर कर लो जो इतना कॉन्फिडेंट है कि उसने अपना पूरा का पूरा पोर्टफोलियो इज 100% इन्वेस्टेड इन हाई रिस्क स्टॉक्स. Maybe it will help them manage the risks better. So thank you for tuning in and thank you for your time. अभी के लिए अलविदा and bye bye. I'll see you in the next one.